Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending May 29th, 2019. So last week was a holiday shortened week and also the end of the month of May, which has been brutal. So the Dow lost 6.7% in May. The S&P lost 6.6%. I want to say something first about this decline in May. This is basically our decline in May. If you've watched these videos or if you're a subscriber or a member, then you know a lot of weird stuff was happening in April. We actually had a small broadening top in all of the averages right here going into May. But the strangest thing that stood out was the fact that volatility was showing signs of professionals either hedging against risk or taking outright positions that would benefit from a market decline. The evidence of this was showing up in April. So this chart I posted on Twitter. My members got this well before I put this out publicly. So this was May 3rd. This was literally 2 days before the trade war escalated and tariffs went up to 25% on May 5th, which was Sunday. This was Friday afternoon. So if you look at this chart, basically what it is the 10-day correlation of volatility versus the S&P 500. They usually have an inverse correlation, which means this is typical down here at -1 or close to -1, meaning inversely correlated. In April, while the market was going up, volatility too was going up. But if you just looked at VIX on a daily basis or a 1-day chart, you didn't see anything. It looked like volatility was very low. So these are like nuances of the market that were giving away hints. But the point is, when you see this kind of activity, it suggests that somebody knew something well ahead of the escalation on May 5th. Okay, and they were using that inside information to adjust their portfolios and to position for that. So we've seen this on a 10-day correlation 3 other times, actually 2 other times this year. The first one was here before the February 2018 sell-off and volatility explosion. The second one was here before October-December sell-off. And this, again, is taken as of May 3rd. So this was before May's sell-off even started, but the evidence was here that somebody knew something that the rest of the market didn't know. Which brings me to the point I'm getting to. So if we look at this decline in May, almost 6.6%. May, the entire month has been deleveraging, but it has been under the radar. It has been quiet. So what I mean by that is it's not panic selling like everybody in the market is just getting out of stocks like December. It is quiet, under the radar, professionals deleveraging risk, moving out slowly, quietly, letting the market bounce a little bit, let buyers get excited because they need somebody to buy the shares that they are selling. If they just went out full out and sold all the shares they want to sell, it would panic the market and the market would have dropped sharply lower. But the point is that the effect is the same. The professionals have been getting out all through May, and we first learned about it back here in April as the market was still going up. There's an old saying about boiling a frog. If you throw a frog in a pot of boiling water, it's going to jump out. If you throw a frog in a pot of lukewarm water and you slowly turn up the heat, you will boil the frog. So they're not just dumping everything and basically cutting themselves off at the knees because everybody's selling. They are trying to sell into the best prices they can, and that's what's been going on all of May. Picking up from where I left off last week, we had the S&P basically coming down here to test this 2800 level. Okay, so this should have been a pretty simple test on a technical basis. You have a support level here at 2800. It's a psychological round whole number that markets are attracted to. Humans, the human mind is attracted to, and it had this 200-day moving average below. So from a price perspective only, this should have been a pretty simple test of 2800. I said in the last video I thought that we would test 2800 early in the week. We did that right here on Tuesday. This looks simple, like a simple test. There were a lot of things that were much uglier, from small caps, major auto manufacturers, semiconductors. All these growth sensitive sectors were not confirming the probability of a solid test. So we broke 2800. This 200-day moving average held for Wednesday and Thursday. Really low conviction trade on the part of buyers. Could not even fill that gap. Resistance right at 2800 and left this looking very weak and open to more weakness, which came as President Trump escalated tariffs, this time on Mexico. So this 200-day moving average failed, but this was psychological technical support. The real level of support was 27.85. That's price support. That's more important. That's what failed. And when that failed, we made the first lower low of the year. We have correction here, correction here, correction here, all higher lows. That means the uptrend is intact. Last week I said we're going sideways now with this 27.85 level from March 25th being key. And now we have made the first lower low. From a simple measured move perspective, my guess is that we have this first leg consolidation, second leg. That's usually how it goes. We get a first leg consolidation, second leg. My guess from a measured move perspective is that we could go probably as low as 2,700 on this move, but probably somewhere between 2,700 and about 2,740 up in this area. There's a lot of trend lines here. Just bear with me for a minute. I'm seeing a lot of traders that are of the opinion that the market is too low, that President Trump is not going to accept that, and that there's going to be some bullish tweet out over the weekend. What you basically have is a series of lower highs and lower lows all the way down here. So if you want to look at it and say, well, President Trump could come out with this tweet and send the markets higher, that's fine, but the evidence says different. The evidence says what we have is lower highs and lower lows. This kind of looks like a little flag-leg pattern. So my guess, just based on a measured move of equal legs, first leg, second leg, is somewhere down here around 2,700 to 2,740, testing this pivot low from May 8th. That said, the market is extremely oversold in breadth terms. So this is a 60-minute chart of the S&P in green, and this is the NYSE new high, new low ratio. Over here, as of Friday, you can see that it hit the lowest level, the most oversold level, goes between 0 and 100 since December 24th, that market sell-off. Now, markets can stay overbought much longer than you think. Like up here, we're at 100 for a long time. Down here in December in the sell-off, that was like 9 days of pegged at 0, like as oversold as you can get. So it could stay oversold longer, but the probabilities favor right now this market getting some relief, whether that be in the form of a bounce or a consolidation, which will look like a bounce on a day-to-day basis. I have been long Treasuries, and that has been expressed in TLT. And this has been a fantastic, very bullish chart. Nice looking 3C charts, underlying trade showing buyers there. But it exploded higher as the market went lower this week. So this was a rush to safety. I personally have traded this in two legs. Leg one here, got out for this consolidation. Leg two here. And my target range since really March, coming from this big bull flag, was 129 to 130. So I got out right here, right there on Wednesday, towards the top of that range in the 129.80 region, which is right between 129, 130, my target range. And one of the reasons was because it hit my measured move target. And another reason was because we had a big resistance area back here near 129.70, 130. It went much higher this week on Thursday and Friday, and that's fine. I had an objective area with objective evidence for my exit. It went a little bit higher, missed out on some extra gains, but this was a 320, just this leg alone was a 320% return on investment. And we got into something else on Thursday that made just as much as TLT. That something else was gold, and we've been waiting on this one for a long time too. So here's a daily chart of GLD. Been what, 1, 2, 3, almost 4 months of waiting. Had an entry long on Thursday, right here, right before it broke out, or right about as it was breaking out. You know, it has great evidence. Look at all these bullish flags, bullish wedges, bullish pennants, another big bullish wedge. I mean, the evidence is there. It was a strong trade. It was just a matter of waiting for the underlying flow, which basically means, for those of you who are watching on YouTube, evidence of stronger buying than what we've seen in here that suggests that we're getting ready to make a breakout. The other thing that was nice was a higher low over here. It didn't come all the way down to this trend line. It's off to a good start. Look at the way it closed both Thursday and Friday at the highs of the day. That's spectacular. That's what you're not seeing in stocks. That's what you're seeing in gold, which is a safe haven, and you're seeing in TLT. For members, I'll keep you updated what the underlying flows look like. But so far, the 3C charts have just been fantastic. Here it is, the 1 minute chart of 3C and GLD. And Monday morning, or Monday afternoon, that's one of the first things I said. We weren't getting Any negative action over here is just consolidation. And that initial spark of buying carried through Wednesday again as prices are pulling back here just a little bit. Thursday as we're going sideways, and just blasted higher on Friday. So let's wrap this up. Again, like I said earlier, I would lean towards just a measured move from a measured move alone. Leg 1, consolidation. Leg 2, and notice that is a bearish descending triangle. I would think somewhere around 2700 to 2740. Test this March 8th low. In terms of price action itself, there's nothing good happening here. Okay, we're making lower highs, lower lows. Small caps are leading lower. Treasuries are blasting higher. Gold as a safe haven is breaking out. As I've been talking about all week, the Japanese yen versus the US dollar has been bid. So below this 109 level meant risk off, and it just plowed through that on Friday. Take a look at crude. This is USO. It is ugly. Over here, no bounce, just consolidation, and this is how we ended the week. Take a close look at that. Crude lost over 9% last week and has lost about almost 17% in May alone. So when you get something like this, these big gap down, and you have a close near the low of the day, this is not bullish at all. And this goes to risk sentiment. I know crude is different than stocks, but it goes to risk sentiment. It is really ugly. So I think the market has some more work. It's getting oversold, and that's just due to the length of this sell-off. But it hasn't been a big sharp sell-off like we see in crude. It's been very methodical, very orderly. That is the sign of professionals moving out of the market and handing off those shares. And what do you think they've been buying? They've been buying the safe havens, Treasuries, gold. Members, I will see you Monday morning, and we will start digging up that evidence again, laying out the puzzle pieces and putting together these trades. Have a great weekend, everybody.